Hey everyone, we're here for the FOMC party. FUMC as Hafed put it. That was great. And we got to start a little bit late after the fact, but long and short of it here. Headline is Fed raises main rate by 25 beeps. I think everybody was expecting at least that. And our rule here, of course, is don't trust the first hour following the Fed announcement. So if anything, if you're taking trades right now, you're asking for trouble. Anyway, we'll see how this goes. I'm not quite sure what Chris is showing on YouTube, but I didn't think we really need to see my ugly mug through this. So we got some charts. We will have Mr. Chipal, I suppose, speaking in shortly. If somebody can throw the link to the FOMC press conference in the lounge, I'd appreciate it. And I suppose I can play it all like over top of the screen here, or we'll figure something out. Maybe we'll just give it. Yeah, maybe just like make it the size of like one of these little boxes. And then that way, yeah, like play the link with the sound on your own computer, on your own device. Although the playback afterward probably won't have you speak, will it? But hey, thank you. Oh, Chris, you've got the link. Awesome. I mean, I could probably, we'll throw this link just into here. Into the, I mean, everybody should have that, right? It's pretty straightforward. There's the 230. Yeah, exactly. So, the rule, Brian, I don't know how long you've been following the Fed, is try not to take a trade for the first hour following the Fed announcement. It's usually a bit dangerous. And these days, I've actually noticed that you're probably best just to give the market at least a day or two, maybe even on the daily charts, hunt for like a fractal or something to actually give you direction. Because you might just get absolutely chopped up in the wash. So anyway, let's see how it goes. All right, so knee-jerk reaction clearly, and actually, is it any better if I bring the microphone over here? Test. Is that better? All right, anyway. So knee-jerk reaction right out of the gate, US dollar moving higher. I think that seems logical considering they just raised rates. So anybody who's running an algo, if the US raises rates, buy more US dollars and lock in those T-bills. Probably a lot of that's happening right now. Euro on the bottom, Japanese yen on the top. I mean, we got basically the same thing. This is the market matrix that I like to follow. I like to follow these to capture sort of more of like the swing trades. So I set them off of like the half-hour charts, 27 minutes for all you Tesla fans. And then a little bit of a longer-term look on the US dollar index off them. They daily. Sometimes I have this like 12-hour, 6-hour chart. So you can see US dollar has been going down quite a bit here. So seeing a bit of a dead cat bounce really wouldn't be too much of a shock. Same thing on the euro. If we am out here, I'm seeing it pull back into support, maybe even 50% retracements, all that kind of fun stuff. That would make sense. Swiss franc looks awfully toppy. I did notice that the commodities were looking rather toppy here. So that actually surprised me a bit. Gold kind of stalled out right up at the top end of its range here. So same thing. If we see and probably this will move in unison. If you see the Swiss franc roll over here, if you see the euro roll over here, odds are gold's going to roll over as well. Interesting how silver really didn't get going there, eh? But you could see the inverted head and shoulders. So if coming out the other side of this, we bust up through this resistance line, looks like about 2380, somewhere in that area. You're probably going to have a nice little pop there. So keep your eyes peeled. Was surprised to see how they knocked the crude oil market down, eh? Look at that. That's actually quite surprising, seeing that pretty noticeable double top there. Triple top, look at that, boom, boom, boom. So breaking trend lines. This is, if anything, what I'm worried is going to happen here sort of through the month of February, especially the beginning part, is we start to see the risk on part of the markets deteriorate. Interesting, if we just draw a trend line here, 2.618. That's a coincidence. So anyway, you might actually see a bit of volatility, but that ends up actually turning into some sort of bottoming pattern here. You could probably do reload zones off of that range as well, right? So that's probably a reload zone in there. So that's interesting. We'll keep an eye on that one. Keep in mind over this hour, ooh, look at the US dollar cranking higher here now. Krankovich is crankovitching. I wonder who's rocking the party here. I've been talking about the Canadian dollars looking a little bit suspect. It's kind of rolled over with that energy market. Bitcoin's catching a bit of a bid here. That's interesting to see. I'll be watching this spreads. This spread indicator is so awesome. If you can clearly see it's wedging out here. So probably, following Chair Powell speak, this thing will probably resolve one way or the other, and it'll be sort of our tell as to what happens here. So top of the wedge, I don't know whether we go all the way there, but something like that. You can see we're building to something here. Actually interesting how that might have been like a little FU move. So this thing moves opposite. If you see this thing cranking down, it means crypto's rallying. So keep an eye on that thing. Again, remember folks, don't trust anything through this first hour. We got to let the whole hour sort of resolve itself. I think that's half the reason why they created this press conference. And I said in the daily brief recap today, that kind of thinking. So, all right, looks like US dollar's calming down a little bit here. Lower time frame charts must be just all over the map. Let's see what we got. Yeah, look at that nonsense. Woo-wee, up and down like a you-know-what. Bond market seems to knee-jerk reaction was to head lower. So that makes sense on 25 basis point increase. Of course, how Powell sort of talks is going to dictate how this thing goes. But I might make the argument that, this was what I'm worried about. This is buy the rumor, and now this becomes sell the news. So that's a little bit concerning. And of course, interest rates are the big driver for all of us here right now, right? That's what's dominating this. Is inflation over and all that? So you can see how the market on the long end hasn't broken down. But on the 10-year note, the market actually has broken down. There is officially a smile here. So it'll be, again, don't trust anything in the first hour. But the knee-jerk reaction was to go and break that. So there's actually bearish structure working on that 10-year now. So that's interesting. Let's see, anything else we can discern off of these things? I don't really have this set up too well just yet. I was going to put the 5-year and the 2-year up here. I do have all of them. Here, let's move this over here. I do have all of them, well, over here. So on the 27-minute chart, you can see the 2-year note's kind of humming and hawing, and that would make sense. I think they pretty much, the 2-year and the euro dollar kind of track short-term interest rates really closely. And I think they priced this 25 basis point move in. So that should actually be like a non-event. Interesting how stocks are catching a bid here. So again, do we really want to read too much into this? What's interesting is how Bitcoin acting as a bit of a leading indicator. Still think that we have to wait for this wedge to resolve before we make any grand conclusions. This just might be the first hour nonsense going on right now. Anyway, shorter term, let's go back to that image. Gold and silver, gold catching a bit of a bid. And interestingly enough, I actually, people listen to Peter Schiff and all that kind of craziness. I think in the first part of the inflation cycle, gold doesn't really do that well. Second part of the inflation cycle, ironically enough, think of we are now in the part of the cycle where Ronald Reagan just fired the air traffic controllers. So that's kind of what you're seeing what the Fed's trying to do with the jobs market right now and the demand for workers. It's basically the same conversation right now. So does the Fed, we were talking about this in the daily brief today, I think, to a certain degree. What does the job opening status say? If there's more jobs and the companies want to keep hiring more and more and more, Fed's got to keep its foot on the gas, or on the brake, keep raising rates. Anyway, well, listen for those kind of hints from Powell today. Stocks, they look like, actually, that's a longer term chart. Let's maybe go down to lower time frame. There we go. So interesting how the knee-jerk reaction right out of the gate was down, both on the ES and sort of the legacy market, the Dow. This perfect example of what I mean by don't trust that first hour, right? So anybody that was long, this move just washed them all out. Tripped up the stops, ding, 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 ding. So as soon as they clean out, you can see the double bottom here. I'm sure there's a lot of people that bought the market there. Well, I mean, W's are W's are W's. www by the w.com. You know how it goes. And on that event, this was a beautiful just stopwash. Just clean out all of these stops, liquidity hunt, done. And of course, anybody that was like, okay, yeah, I'm going to short that Fed decision, and they probably put their stop right above here. Market tanks. Oh, look at me, I'm so smart. And then boom, they stop them out on the other side. I mean, absolutely cliche. And now, interesting enough, look how a 3-bar fractal is coming in here now on legacy. And actually, look at that. You got a 3-bar fractal coming in here on the ES. So if I did, we probably should do a chart of NQ stock market for the next 100 years. And look at that weekly chart. Oh, goodness. Hey, I'll tell you, January barometer. Oh, my goodness. You can see the base of the next monster bull market being formed now. And this is fascinating, right? Because if you go out into the public and you ask the public, what do you think, Mr. Public, about investing in stocks? They probably tell you it's all a crime, it's all crookery. Only that Allen guy and Mr. Bezos make money at it. Everybody else gets screwed. Something like that. Anyway, so fascinating how that weekly W. It's tough to be bearish in the face of that. January finished incredibly strong. But we're talking about Fed right now. So this is short-term shit, Brian. Excuse my French. So interesting how we talked about the 3-bar fractal there in the legacy, and then ES, of course, is sort of like the whole market, the top 500 stocks. So fractal there. On the NASDAQ, interesting. Actually, let's go 3-minute here. We got 3-minute charts on these. So yeah. All right. There is that. Actually, it almost looks like an inside bar too. Sure, there's probably an interesting name to this candlestick pattern. Let's see. That high is 450. This high is 375. So yep, that is a lower high. So that is a 3-bar fractal fail. And if we go through this low, that'll be a 5-bar fractal fail. Ooh, look at that. It just triggered. So that's a pretty bearish sign. You can see the 5-bar fractal fail came in on the Dow, and the 5-bar fractal looks like, yeah, it just came in there on the ES as well. This is interesting because you could say, like, there is the whole fractal. I guess it would also be this candle as well. So sloppier than slop. But the market did just fire a cute little sell signal there. So it's weak. Interesting how the bond market, so you can see how the bond market is really taking its cues from the stock, or the stock market is taking its cues from the bond market. Beg your pardon. All right, and then the other one we really want to see here is we want to see R2K. Now, what the hell is the Russell 2000? Well, I guess we'll just do the futures. No, that didn't work. Russell. Hey, RE Mini Russell 2000. There we go. All right, and we will put him down below. And the candles. All right, so now we get the whole market. All right, so an interesting. Looks like the Russell 2000 is actually leading the market here. Notice it's got the biggest green candle. There goes the Nasdaq. It's trying to rally. All right, let's keep an eye on that. You can see the fractal trying to come in on the gold market. Looks like everybody came down, they thumped down, and now everybody's pausing. And notice, look at the gold starting to fade here. Oh, just turned red on that 1 minute candle. So let's see if we break through that low. If we break through that low, I bet that's like going to be a continuation pattern and we dip all the way back down here. That'd be an interesting little day trade to follow. Stocks still holding on to their bid. You can see Russell 2000 might turn into like a little bit of a railroad tracks there. All right, and we've got Bitcoin, of course, center of the universe. Let's throw on maybe ETH with that as well. And then that way we've got pretty good view of crypto on the short term. Something like that. Wow, look how closely Ethereum and Bitcoin are moving here. That's interesting. New pane below. Sure, that means something. All right. Hey, that's cool. Can you hear that music? Where's that music playing? That's cool. I think that's from the FOMC webpage, isn't it? I don't know whether you guys can hear that or not. All right, let's see what we got here. Wow, look how thin this is. Oh my goodness. There's no trading at all. Oh, that's interesting. Chicago guys don't even want to touch crypto through this. They're just like, I'm leaving that shit alone. What do you guys like? ETH, like it's got to be like a Binance futures or something like that we can follow. Ooh, look at this perpetual future. Look at that symbol. Wow. Try saying that 10 times fast. Oh, same thing. Just as thin. Oh, that's up here. Oh, damn. That's stupid. Okay. And then let's do, yeah, delete that. And then we'll go add and BTC USD. To have the Binance perpetual futures, that would be kind of cool. I did both of those. Doesn't look like it though, eh? There's Tether. Hey, there you go. USDT perp. Let's go with this. What it looks like. Oh, fudge. Oh well. Like we'll let Ethereum dominate the conversation today. It'll make all the Bitcoin maxis go crazy. Candles. All right. I should move this up. Okay, so interesting. Corn's actually just quieted right down here, right? That's interesting. Let's see, what would be a good oh yeah, I was gonna put oh yeah, there's the euro dollars and then the 2-year note. What the hell's the 2-year futures? Jeez, I can't even remember. Three-year, 5-year, 10-year. So no, what's the 2-year bond? Oh, that's weird. All right, my brain's gone dead. Somebody help me. What's the 2-year bond futures? Maybe it's the T-notes, US Treasuries. Yeah, it's been a long time since I pulled up a 2-year bond. Huh? 2-year like that. It might be like T-note. I bet 2-year T-note. 3-year. What the hell is this? MYX. I don't even know what that is. But no, don't look like it's T-note. 10-year. 5-year. 2-year. There it is. ZT. Yeah. All right. So we'll move this. And actually this should track more closely Fed. Isn't that interesting? What time frame is that? Oh, weekly. Let's go down to like 3 minutes. Oh, there you go. Now that's telling you the tone of the market. Yeah, market's not very happy. Whoa, yeah, look at that spike on the release there. Ooh, yoy. Wow, so remember we said the bonds fractaled out first, and look at them puking out. Interesting, the stocks are holding on. They fractaled out, but they never did break here. Ooh, the gold did break. Look at that. So the gold did confirm that move, and it's heading lower. Same thing with silver. I don't have the energy market on here. That's too bad. Ah, interesting. Look at Bitcoin. Oh, yeah, the bonds do not look happy here. So this should be a risk-off vote. This should be a risk-off vote. It hasn't really broken yet. Probably when we go through this low here, that would be your risk-off vote. That's definitely risk-off. Interest rates are going up on the long end. This is interesting. They're going up on the longer end, but remember we had said that the 10-year note actually did M out and is leading lower, but the 30-year hasn't M'd out yet. So that's interesting how that's happening. But you can see longer end of the curve is puking out here. In fact, that actually looks almost like a head and shoulders top there. So let's see if this thing really pukes out, right? Nice neckline there. We might get just a big ass dump into here. Notice how they ticked up there. They came right to the break and they went, no, I don't think so. That's cool. All right. Well, the only thing we don't have on here is the energy complex, which we probably should, but what the hell. I've got 4 different interest rate markets. You can see the short end of the curve, the euro dollars, they're not happy at all. 2-year, it's, geez, it had a wicked negative reaction right on the release. And it actually looks like the 10-year is actually trying to put in a little bit of a bottom. Hey, yeah, look at that. 30-year as well. 30-year looks a little bit weaker, but this 10-year actually, I bet there's bond traders that are buying that shit right there. Yeah, look at her go. So somebody may, keep in mind that the FOMC does have sort of prepared remarks. So I almost get the impression that somebody just found out what the script was to today's conversation. And interesting. Look at Ethereum. Ethereum might just put in a nice little double bottom here. Watch if you do trade Ethereum 1578, watch that level. See if we get a pop following that. Interesting how Bitcoin, this per USD chart, I don't even know if this is even relevant. I'm not even quite sure what the hell this is. That low there was 20,050 cents. Interesting. Excuse me, 23,050 cents. This low here, 22,998. So we did actually go a bit lower here. So I think that's right. Open, high, low. So I don't know. That Ethereum chart, that looks like there's something trying. Look at that. So they couldn't break it out through the top. They rejected. So let's watch the stock markets. There you can see the ES looks like Ethereum looked like a minute or two ago. I often say that crypto is a good leading indicator. So you can see Ethereum's coming off, Bitcoin's coming off here. Let's see what happens to these stock indexes. My hunch is they start peeling back here. Ooh, look at that. Some damage being done here. Anyway, never a dull moment. I have to
You were
say,
talking
as
about
price what's that?
you were talking about the 10-year note. There's
Whoa, look at
I see
this.
a
Whoa,
potential
Ethereum
head
just
and shoulder.
broke. Double top breakdown there. Looks like Bitcoin. Remember we said that number there? What's that? 2308.70, and we just did 2299.70. So that's broken. And it looks like Ethereum just put in a double top. It hasn't taken out these lows yet. What are you saying? 10-year note? What's going on? 10-year note? You buying 10-year
Head and
notes?
shoulder pattern.
Head and shoulders, knees and toes.
Yeah, I have a megaphone on that one.
Megaphone.
Yeah.
Let's see what you got here. What time frame?
I am looking at the daily time frame.
Okay. Well, you definitely got a sell signal there. So I don't know whether your megaphone was bullish or bearish, but they're not overly happy right now. Where are the bonds? Here they are. Oh yeah, this is your daily chart. So what do you got going on here? This is a megaphone.
Yes.
All right. Oh, look at that. You even have it overlaid. God, you're so slick. All right. So let's. Oh, he's talking, so I should shut the hell up. Turn my volume down. Like that. Oh, can I mute myself? I can mute myself in the hangout, right? But this isn't a hangout, this is Zoom, right? So where the hell's that?
Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate at a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 247,000 jobs per month over the last 3 months. Although the pace of job gains has slowed over the course of the past year and nominal wage growth has shown some signs of easing, the labor market continues to be out of balance. Labor demand substantially exceeds the supply of available workers, and the labor force participation rate has changed little from a year ago. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in December, total PCE prices rose 5.0%. Excluding the volatile food and energy categories, core PCE prices rose 4.4%. The inflation data received over the past 3 months show a welcome reduction in the monthly pace of increases. And while recent developments are encouraging, we will need substantially more evidence to be confident that inflation is on a sustained downward path. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that's not grounds for complacency. Although inflation has moderated recently, it remains too high. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 25 basis points, bringing the target range to 4.5 to 4.75%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. We are seeing the effects of our policy actions on demand in the most interest-sensitive sectors of the economy, particularly housing. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 25 basis points today, continuing the step down from last year's rapid pace of increases. Shifting to a slower pace will better allow the committee to assess the economy's progress toward our goals as we determine the extent of future increases that will be required to attain a sufficiently restrictive stance. We will continue to make our decisions meeting by meeting, taking into account the totality of incoming data and their implications for the outlook for economic activity and inflation. We have been taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Chris.
Chris Rugaber, the
Look
Associated
at the
Press.
Eurodollar
Thank you for doing
launch.
this. As you know, financial conditions have loosened since the fall, with bond yields falling, which has also brought down mortgage rates, and the stock market posted a solid gain in January. Does that make your job of combating inflation harder? And could you see lifting rates higher than you otherwise would to offset the increase in, or to offset the easing of financial conditions?
So it is important that overall
Stock
financial
market going
conditions continue to
crazy.
reflect the policy restraint that we're putting in place in order to bring inflation down to 2%. And of course, financial conditions have tightened very significantly over the past year. I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance, which is why we say that we expect ongoing hikes will be appropriate. Of course, many things affect financial conditions, not just our policy. And we will take into account overall financial conditions along with many other factors as we set policy.
Rachel.
Chair Powell!
Hi, Chair
Chair
Powell.
Powell's
Thank you for
watching the
taking
US
our
dollar
questions.
break.
Rachel Siegel from the Washington Post. Over the last quarter, we've seen a deceleration in prices, in wages, and a fall in consumer spending, all while the unemployment rate has been able to stay at a historic low. Does this at all change your view of how much the unemployment rate would need to go up, if at all, to see inflation come down to the levels you're looking for?
So I would say it is a good thing that the disinflation that we have seen so far has not come at the expense of a weaker labor market. But I would also say that disinflationary process that you now see underway is really at an early stage. What you see is really in the goods sector, you see inflation now coming down because supply chains
Look
have
at
been
that
fixed,
US
demand
dollar
is shifting
coming
back
off here.
to services, and shortages have been abated. So you see that in the housing services sector. We expect inflation to continue moving up for a while, but then to come down, assuming that new leases continue to be lower. So in those two sectors, you've got a good story. The issue is that we have a large sector called non-housing service, core non-housing services, where we don't see disinflation yet. But I would say that so far, what we see is progress, but without any weakening in labor market conditions.
Has your, I'm sorry.
Go ahead.
Has your expectation for where the unemployment rate might go changed since December?
You know, we're going to write down new forecasts at the March meeting, and we'll see at that time. I will say that it is gratifying to see the disinflationary process now getting underway, and we continue to get strong labor market data. But you know, we'll update those forecasts.
The
in March.
disinflationary process is now getting underway.
Hi, Chair Powell. Neil Irwin with Axios. You and some of your colleagues have emphasized the possibility that job openings could come down and that that would let some of the air out of the labor market without major job losses. We saw the opposite in the December JOLTS this morning, job openings actually rising. That also has coincided with slowdown in wage inflation. Do you believe that openings are an important indicator to be studying to understand where the labor market is and where wage inflation might be heading?
So you're right about the data, of course. What we've seen average hourly earnings and now the employment cost index abating a little bit, still off of their highs of 6 months ago and more, but still at levels that are fairly elevated. The job openings number in JOLTS has been quite volatile recently, and I did see that it moved back up this morning. I do think that it's probably an important.
We talked
indicator.
about this in the
ratio, I guess,
summary.
is back up to 1.9 job openings to unemployed people who are looking for work. So it's an indicator, but nonetheless, you're right. We do see wages moving down. If you look across the rest of the labor market, you still see very high payroll job creation, and quits are still at an elevated level. So by many indicators, the job market is still very strong.
Go to Colby and then Howard.
Thank you. Colby Smith with the Financial Times. Given the economic data since the December meeting, is the trajectory for the Fed funds rate in the most recent SEP still the best guidepost for the policy path forward? Or does ongoing now mean more than 2 rate rises now?
So you're right. At the December meeting, we all wrote down our best estimates of what we thought the ultimate level would be, and that's obviously back in December, and the median for that was between 5 and 5.25%. At the March meeting, we're going to update those assessments. We did not update them today. We did, however, continue to say that we believe ongoing rate hikes will be appropriate to attain a sufficiently restrictive stance of policy to bring inflation back down to 2%. We think we've covered a lot of ground, and financial conditions have certainly tightened. And I would say we still think there's work to do there. We haven't made a decision on exactly where that will be. I think we're going to be looking carefully at the incoming data between now and the March meeting and then the May meeting. I don't feel a lot of certainty about where that will be. It could certainly be higher than we're writing down right now. If we come to the view that we need to write
Stocks
down,
are going right off the board.
to move rates up beyond what we said in December, we would certainly do that. At the same time, if the data come in the other direction, then we'll make data-dependent decisions at coming meetings, of course.
Just as a quick follow-up, how are you viewing the kind of balance of risk between those two options of, the likelihood of maybe falling short of that or going beyond that level?
I guess I would say it this way. I continue to think that it's very difficult to manage the risk of doing too little and finding out in 6 or 12 months that we actually were close but didn't get the job done, and inflation springs back and we have to go back in, and now you really do worry about expectations getting unanchored and that kind of thing. This is a very difficult risk to manage. Whereas, of course, we have no incentive and no desire to over tighten, but if we feel like we've gone too far, we can certainly and inflation is coming down faster than we expect, then we have tools that would work on that. So I do think that in this situation where we have still the highest inflation in 40 years, the job is not fully done. As I started to mention earlier, we have a sector that represents 56% of the core inflation index where we don't see disinflation yet. So we don't see it. It's not happening yet. Inflation.
I bet that
core
crypto
services
wants to
X,
rally here.
X housing is still running at 4% on a 6 and 12-month basis. So there's nothing happening there. In the other two sectors, representing less than 50%, you actually, I think, now have a story that is credible, that's coming together, although you don't actually see disinflation yet in housing services, but it's in the
stays
pipeline, right?
great.
So for the third sector, we don't see anything here. So I think it would be premature, it would be very premature to declare victory or to think that we've really got this. We need to see, our goal, of course, is to bring inflation down. And how do we get that done? There are many, many factors driving inflation in that sector, and they should be coming into play to have inflation, the disinflationary process begin in that sector. But so far, we don't see that. And I think until we do, we see ourselves as having a lot of work left to do.
Howard Schneider with Reuters.
For whatever worse, I heard
just
we're
wanted
going to be
connect a
raising
couple dots
rates.
here. The statement's made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see that, and we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening, and for the reasons we thought. It's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. This is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. And we actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods ex-housing, the core services ex-housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is, research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of headline PCE, which is our mandate. So it's not that we're neither optimistic nor pessimistic. We're just telling you that we don't see inflation moving down yet in that large sector. I think we will fairly soon, but we don't see it yet. Until we do, I think we see ourselves, we got to be honest with ourselves, we see ourselves as having perhaps more persistent inflation in that sector, which will take longer to get down. And we're just going to have to complete the job. I mean, that's what we're here for.
All right, looks like we're finally getting a little bit of exhaustion in that rally.
Nick Timmeros, the Wall
And
Street
he
Journal.
basically
Chair
said that
Powell,
we're
you
gonna keep
observed
raising
several years
rates
ago
until the
that we
labor
learned we can
market
have
shows
low
that
unemployment rate
disinflation
without above
that he
target
sees in
inflation.
other
And
parts
we've
of the
learned
market.
lately that inflation can come down from its uncomfortably high level despite a historically low unemployment rate. Given that, and given how much you did over the last year, why do you think further rate increases are needed? Why not stop here and see what transpires in the coming months before raising rates again?
So we've raised rates 4.5 percentage points, and we're talking about a couple of more rate hikes to get to that level we think is appropriately restrictive. And why do we think that's probably necessary? We think because inflation is still running very hot. We're, of course, taking into account long and variable lags, and we're thinking about that. The story we're telling about inflation is
Crypto
to
sure looks
ourselves,
strong
and
here.
The way we understand it is basically the three things that I've just gone through a couple times. And again, we don't see it affecting the services sector ex housing yet. But I mean, I think our assessment is that we're not very far from that level. We don't know that, though. We don't know that. So I think we're living in a world of significant uncertainty. I would look across the spectrum of rates and see that real rates are now positive, right, by an appropriate set of measures, are positive across the yield curve. I think policy is restrictive. We're trying to make a fine judgment about how much is restrictive enough. That's all. And we're going to, that's why we're slowing down to 25 basis points. We're going to be carefully watching the economy and watching inflation and watching the progress of the disinflationary process.
Did you or your colleagues discuss the conditions for a pause at this meeting this week?
You'll see the minutes will come out in 3 weeks, and we'll give you a lot of detail. We spent a lot of time talking about the path ahead and the state of the economy.
Let's see if this Harami
I
fires
wouldn't
on
wanna start to
good
drive
old
describe
US
all the
dollar
details
index
there, but
here.
that was
You
the
can
sense of
see the
discussion, was
coil
really
tightening.
talking quite a bit about the path forward.
Victoria?
Chair Powell!
Hi, Chair Powell. I wanted to ask about the debt ceiling. Given that we've now hit up against it, I was
She
wondering
wants
if
to
the
have
U.S.
his
goes past the X
baby.
date, will the Fed do whatever the Treasury directs as it relates to making payments as the fiscal agent, or will it do its own analysis of any legal constraints?
So your question is, would we, say your question again?
Will the Fed do what Treasury directs as it relates to making payments, or will it do its own analysis of any legal constraints?
So you're really asking about, you're asking about prioritization in effect, is what
Yes,
you're, okay.
yes.
So I feel like I have to say this. There's only one way forward here, and that is for Congress to raise the debt ceiling so that the United States government can pay all of its obligations when due. And any deviations from that path would be highly risky, and that no one should assume that the Fed can protect the economy from the consequences of failing to act in a timely manner. In terms of our relationship with the Treasury, we are their fiscal agent, and I'm just going to leave it at that.
Are you actively doing any planning of what might happen in the event that that would happen?
I'm just going to leave it at that. This is a matter that's to be resolved between, it's really Congress's job to
It's
raise the debt
Congress's
ceiling,
job to
and,
raise the
I
debt
gather there are
ceiling.
discussions
Did you hear
happening, but they
that?
don't involve
Not
us.
debate
We're not,
about it, but do
we're
it,
not
damn
involved in those
it.
discussions, so we're the fiscal agent.
Gina and then Steve.
Gina Smilik from the New York Times. Thanks for taking our questions. I wonder, was there any discussion today of the possibility of pausing rate increases and then restarting them? Lori Logan from the Federal Reserve Bank of Dallas seemed to suggest that that would be a possibility in a recent speech, and I wonder if that view is broadly shared on the committee.
So the committee, obviously, did not see this as a time to pause. We judged that the appropriate thing to do at this meeting was to raise the federal funds rate by 25 basis points, and we said that we continue to anticipate that ongoing increases in the target range will be appropriate in order to attain that stance of sufficiently restrictive monetary policy that will bring inflation down to 2%. So that's the judgment that we made. We're gonna write down new forecasts in March, and
Right you are, Mr. Del Moody.
The incoming data, as everyone else will.
Sorry, I should have been clear. I mean, would it be possible to take a meeting off, for example, and then resume? Could you, rather than just doing at every meeting a move, go a little bit more slowly, take some gaps in between moves?
I mean, I think This is not something that the committee is thinking about or exploring in any kind of detail. In principle, though, we used to do was go every other meeting, if you remember, 25 basis points, and that was considered a fast pace. So I think a lot of options are available, and I mean, you saw what the Bank of Canada did, and they left it that they're willing to raise rates after pausing. But this is not something that the Federal Open Market Committee is on the point of deciding right now.
Steve Leisman, CNBC. Mr. Chairman,
Here comes the
the
tough
S&P has
questions.
the PCE inflation rate in 2023 at 3.1%. Meanwhile, the 3-month annualized PCE is 2.1%, and you've achieved this without going to your 5.1% funds rate, which is what you have penciled in for this year. And you've also achieved it without the 1 percentage point increase in the unemployment rate, which you have penciled in for this year. I'm wondering if you've considered the idea of whether or not your understanding of the inflation dynamic may be wrong, and it's possible to achieve these things without raising rates that high, and also without the surge in unemployment. And specifically, I wonder if you might comment on the speech given by Vice Chair Lael Brainerd, who said, to the extent that inputs other than wages may have been responsible in part for important price increases for some non-housing services, an unwinding of these factors. In other words, it may not be wages, the idea that it may not require unemployment rising to get this sector of inflation under control. Thanks.
So a couple things. First, on the forecast, you're right. If you take very short-term, three-month, say, measures of PCE, core PCE inflation, they're quite low right now, but that's because that's driven by significantly negative readings from goods inflation. Most forecasters would think that the significantly negative readings will be transitory, and that
He didn't just say
inflation will move
transitory
up
again, did he?
fairly soon back up to its longer run trend of something around 0, something like that. So a lot of forecasts would call for core PCE to go back up to 4% by the middle of the year, for example. So that's really where the sustainable level is more like at 4%. So that would suggest there's work left to do. Let's say inflation does come down much faster than we expect, which is possible. As I mentioned, obviously our policy is data dependent. We would take that into account. In terms of the core non-housing services, as I mentioned earlier, it's a very diverse sector, 6 or 7 sectors, and so sectors that represent 55 or 60% of that subsectors of that sector we think are sensitive to
Fractals,
slack in the economy,
fractals.
sensitive to the labor market in a way. But some of the other sectors are not. And for example, financial services is a big sector that's really not driven by labor markets, wages. So that's why I said there are a number of things that will affect. Take restaurants, right? So clearly labor is important for restaurants, but so are food prices. And transportation services is going to be driven by fuel prices, for example. So there are lots of things in that mix that will drive inflation. I would say overall, though, my own view would be that you're not going to have a sustainable return to 2% inflation in that sector without a better balance in the labor market. And I don't know what that will require in terms of increased unemployment, your question. I do think there are a number of dimensions through which the labor market can soften. And so far, we've got, as I mentioned, in goods, we have inflation moving down without the softening in the labor market. I think most forecasters would say that unemployment will probably rise a bit from here, but I continue to think that there's a path to getting inflation back
just said
to
the
2%
magic
without
ugly.
a really significant economic decline or a significant increase in unemployment. And that's because the setting we're in is quite different. The inflation that we originally got was very much a collision between very strong demand and hard supply constraints, not something that you really have seen in prior business cycles. And so now we see goods inflation coming down for the reasons we thought.
The only reason why there was that insane
we
increase in
understand why
demand
housing
is because
inflation
you
will come
flooded
down,
the
and I
market
think
with
a
money,
story
you
will emerge
doofus.
on the
But of course, that's all part of the
non-housing
plan,
services
isn't it?
sector soon enough. But I think there's ongoing disinflation, and we don't yet see we don't yet see weakening in the labor market, so we'll have to see.
Can we get there with 5%?
Certainly possible. Yeah, absolutely, it's possible. It's a question. No one really knows. I think it's because this is not like the other business cycles in so many ways. It may well be that that it will take more slowing than we expect, than I expect, to get inflation down to 2%. But I don't. That's not my base case. My base case is that the economy can return to 2% inflation without a really significant downturn or a really big increase in unemployment. I think that's a possible outcome. I think many forecasters would say it's not the most likely outcome, but I would say there's a
And what do we say whenever someone says this time it's different?
Michael McKee from Bloomberg TV and Radio. I'd like to pick up on what you were just saying about a substantial downturn and ask, with the full weight of your tightening not in place yet, and with the progress against inflation, there's still a lot of talk about very, very slow growth going forward in 2023. And the recession indicators are all suggesting that we are going to see recession this year. So I'm wondering if you've changed your view, or you have a more nuanced view of what you think the danger to economic growth is going forward, and whether you're very close to perhaps tipping it into the wrong place, which calls for more restraint on your part.
So I do think most forecasts and my own assessment would be that growth will continue, positive growth will continue, but at a subdued pace, as it did last year. We had growth of GDP growth of 1% last year, and also final sales growth, which we think is a better indicator of about 1%. I think most forecasts and certainly my assessment would be that growth will continue at
so 5% inflation, 1% growth.
This year. There are other factors, though, that need to be considered. You will have seen that the global picture is improving a bit, and that will matter for us potentially. The labor market remains very, very strong, and that's job creation, that's wages. As inflation does come down, sentiment will improve. You also, state and local governments are really flush these days with money, and many of them are considering tax cuts or even sending checks. So I think that's going to support. They're also spending a lot. There's a lot of spending coming in the construction pipeline, both private and public, and so that's going to support economic activity. So I think there's a good chance that those factors will help support positive growth this year, and that's my base case is that there will be positive growth this year.
Rich?
Thank you. Rich Miller from Bloomberg. First of all, how are you doing?
Fine, thanks. Fine.
Good. Second off, I think earlier on in the press conference, you said you need to see substantially more evidence of inflation coming down. Can you give us some idea of what you're thinking of? You mentioned 3 months. That we
Watch that yen.
Governor Walters suggested he might want to see 6 months. Is it just the inflation data, or do you have to see the labor market coming back into better balance to have that substantially more evidence metric?
I don't think there's going to be a light switch flipped or anything like that. I think it's just an accumulation of evidence. So of course we'll be looking, by the time of the March meeting, we'll have 2 more employment reports, 2 more CPI reports, and we'll be looking at those carefully, as all of us will, and we'll be asking ourselves, what are they telling us? And soon after that, we'll have another ECI wage report, which, as you know, is a report that we like because it adjusts for composition and it's very complete. And the one we got, I guess it was yesterday, was constructive. It shows wages coming down, but still at a high level. They're still at a level that's well above where they were before the pandemic. So I don't want to put a number on it in terms of months, but as the accumulated evidence comes in, it's going to be reflected in our assessment of the outlook, and that will be reflected in our policy over time. But I will say, though, it is our job to restore price stability and achieve 2% inflation for the benefit of the American public. We're not market participants have a very different job. And it's a fine job. It's a great job. In fact, I did that job for years, but in one form or another. But we have to deliver that, and so we are strongly resolved that we will complete this task because we think it has benefits that will support economic activity and benefit the public for many, many years.
Edward.
Thank you, Michelle. Thank you, Fed Chairman, for taking the questions. So,
Fed Chairman,
had
Fed
solid,
Chairman. You're not my buddy
job
anymore.
growth
You're no longer
in
Chair
the small
Powell.
business,
You're
by
Fed
the way.
Chairman.
We had solid job growth, a slight falling in the increase in consumer spending. It seems so far it's been relatively mild from the economy to go from a 9.1% CPI inflation to 6.5% CPI inflation. Is the hard part yet to come to go from 6.5 to 2?
I don't think we know, honestly. So we, of course, expected goods inflation to start coming down by the end of 2021. And it didn't. It didn't come down all through 22. And now it's coming down, and it's coming down pretty fast. So I would say this is not a standard business cycle where you can look at the last 10 times there was a global pandemic and we shut the economy down. And Congress did what it did, and we did what we did. It's just
Everybody
it's
just
unique.
flooded
So
the system with
I
too
think
much money, and we all
certainty is
really
just
fucked
not
up our
appropriate
jobs.
here. Inflation, it's just harder to forecast inflation. It may come down faster. It may take longer to come down. And, our job is to deliver inflation back to target, and we will do that. But I think
I'd say this time it's different, but
declaring victory
that's
and,
pretty much
sending
business
signals
as
that,
usual, isn't it?
that we think that the game is won, because we've got a long way to go. It's the early stages of disinflation, and it's most welcome to be able to say that we are now in disinflation. But that's great, but we just see that it has to spread through the economy and that it's going to take some time. That's all.
How long do you see then the federal funds rate remaining at this elevated level?
So my forecast and that of my colleagues, as you will see from the SEP, and I mean, there are many different forecasts, but generally, it's a forecast of slower growth, some softening in labor market conditions, and inflation moving down steadily, but not quickly. And in that case, if the economy performs broadly in line with those expectations, it will not be appropriate to cut rates this year, to loosen policy this year. Of course, other people have forecasts with inflation coming down much faster. That's a different thing. If that happens, if inflation comes down much faster.
I think he
we'll be
said
seeing
a few
that,
minutes
and it
ago,
will be
core
incorporated
inflation
into our
should
thinking
go
about
back up.
policy.
And we know, buy your unleaded in the middle of February, sell at the middle of May.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask a further question about the language around ongoing increases? That, of course, implies at least 2 further rate rises. If you look at Fed Fund futures pricing, the implication is that you'll raise rates one more time and then pause. Are you concerned about that divergence, or do you think if everything breaks right, is that a plausible outcome?
I'm not particularly concerned about the divergence, no, because it is largely due to the market's expectation that inflation will move down more quickly. I think that's the bigger part of that. So again, as I just mentioned, our forecasts, different participants have different forecasts, but generally those forecasts are for continued subdued growth, some softening in the labor market, but not a recession, and we have inflation moving down. Into the somewhere in the mid-3s or maybe lower than that this year. We'll update that in March, but that's what we thought in December. Markets are past that. They show inflation coming down in some cases much quicker than that. So we'll just have to see. And we have a different view, it's a different forecast really. Given our outlook, I don't see us cutting rates this year if we get if our outlook turns true. As I mentioned just now, if we do see inflation coming down much more quickly, that'll play into our policy setting, of course.
Hi, Chair Powell. Scott Horsley from NPR.
Bonds look exhausted, but stocks still rocking. Crypto's looking a little tired.
Public health is among the data points you'll consider in assessing conditions. What should we make of that? Does the Federal Reserve no longer see the pandemic as weighing on the economy?
That's the general sense of it. Look, we understand, I personally understand well that COVID is still out there. But
COVID's still out there.
that it's
Chuckle,
no
chuckle,
longer
chuckle,
playing
chuckle.
an important role in our economy. And, we kept that statement in there
Scamdemic.
for quite a while. And I think we knew we would take it out at some point. There's never a perfect time. But we thought that, people are handling it better, and the economy and the society are handling it better now. It doesn't really need to be in in the Fed's monthly, or, post-meeting statement as an ongoing economic risk, as opposed to, a health issue.
Nancy.
Hi, Chair Powell. Nancy
Hi,
Marshall
Chair Powell.
Genzer,
I'd like my
with
daughter to have your
Marketplace.
baby.
I wanted to go back to another thing that Fed Vice Chair Lael Brainerd said recently. She said she doesn't see signs of a wage price spiral, and I'm wondering if you agree with that.
I do. Yeah, I do. You don't see that yet, but the whole point is, once you see it, you have a serious problem. That means that effectively in people's decision-making, inflation has become a really salient issue, and once that happens,
Bonds just fractaled.
That's what we can't allow to happen. And
Yen looks like it just
so that's
fired.
why we
I
worry
think we
that
just
the
went
longer
through
we're
that
at
key
this, and the
low.
longer people are talking about inflation all day long, every
77,965.
day, the more risk of something like that.
77,985 right now.
It's
Close.
more of a risk. It always has been more of a risk than anything else. By the way, I think it's becoming less salient, and people are, we pick that up in conversations, and I've seen some data too that show people are, gradually, they're glad that inflation's coming down. People really don't like inflation, and as we see it coming down, that could also add a boost to economic activity. You look at the sentiment surveys now, and they're very, very low. With 3.5% unemployment and, high wage increases nominally by historical standards, why can that be? It has to be inflation, right? So I think once inflation is seen to be coming down in coming months, even, you will also see a boost to sentiment, I hope.
So that's what you're looking at most closely is consumer expectations.
That's at the very heart. It's consumers and businesses essentially. We believe that expectations of future inflation are a very important part of the process of creating inflation. That's a sort of a bedrock belief. In one way or another, it has to be. We think it's important. And in this case, I would say the risk 8 months ago or so, longer-term inflation expectations had moved up. We moved quite vigorously last year. Expectations seem to be well anchored, including
Nice read,
the shorter
David.
end now, not just the longer end. So it's, and I think that's very reassuring. I think, the
Notice
markets
the
have
corn's
decided,
looking a little
the public has
tired here.
decided that inflation is going to
So
come
we got
back down
yen
to 2%.
looking
It's just a
toppy.
matter of us
It looks like
following
the
through.
euro just
That's
fractaled. The
immeasurably
US dollar
helpful
just
to the process
fractaled.
of getting inflation
Gold
down.
just
The fact that people
fractaled. Silver
now do
just fractaled.
generally
Holy crap.
believe that it will come down. That'll be part of the process of getting it
And
down.
look,
It's a
you got
very
your old
positive
Bitcoin here might double top. We had that Japanese yen sort of leading the charge here.
Thank you, Chair Powell. Greg Ropp from MarketWatch. In the minutes of the December meeting, there was a couple sentences that struck people as important. When the committee said participants talked about this unwarranted easing of financial conditions was a risk, and it would make your life harder to bring inflation down. I haven't heard you talk much about that today or in the statement, so I was wondering, has that concern eased among members, or is that still something you're concerned about? Thank you.
I would put it this way. It's something that we monitor carefully. Financial conditions didn't really change much from the December meeting to now. They mostly went sideways or up and down, but came out in roughly the same place. It's important that the markets do reflect the tightening that we're putting in place. As we've discussed a couple times here, there's a difference in perspective by some market measures on how fast inflation will come down. We're just going to have to see. I'm not going to try to persuade people to have a different forecast. But our forecast is that it will take some time and some patience, and that we'll need to keep rates higher for longer. But we'll
Man,
see.
that's one hell of a strong U.S. economy, eh?
Hi, Chair Powell. Brendan Peterson with Punchbowl News. I wanted to ask if the Fed takes into account at all the debt ceiling when it comes to quantitative tightening, given the fact that rapid or faster quantitative tightening could bring us closer, faster to that drop-dead debt ceiling deadline. Could it play an effect as we get
Whoa,
closer
this should be
to
interesting.
that drop-dead deadline this summer?
it's very hard to think about all the different possible ramifications. And I think the answer is basically, I don't think there's likely to be any important interaction between the two, because I believe Congress will wind up acting, and as it will and must in the end, to raise the debt ceiling in a way that doesn't risk, the progress we're making against inflation and the economy and the financial sector. I believe that will happen. I believe it will happen. We of course will monitor money market conditions carefully as the process moves on. For example, the Treasury General account will shrink down and then it will grow back up, and we understand there'll be lots of flows between there and the overnight repo facility and reserves. We understand all that. We're watching it carefully. We'll just be monitoring it. Thank you very much.
Interesting. He ended it on that note. Of all questions to end on, eh? He always ends these events so unceremoniously, sort of like, okay, that's it? We're done? Wow, now that's fascinating. So interesting. I wonder how you interpret this, because notice this Japanese yen top came in here right at the end. So if I'm not mistaken, this thing won't be a buy. Keep in mind, it's just 3-minute chart. But this thing won't be a buy again until you actually see a W on the other side of this trend line. That's interesting. Notice also too, this euro. Look how it went and topped out. That was a bit of a surprise. So don't be so, if anything, what's happened here is the market's built in a bit of a cushion. Now we can just backfill here and, no problem whatsoever. So fascinating. I do like that short though. That's actually not a bad short. Probably something like, move your stop to scratch when 50% of this has been hit. So where's that? Interesting. The next video that's placed on my YouTube channel is Conference on Diversity and Inclusion in Economics, Finance, and Central Banking. Are they trying to program us a little bit? So we'll see how this goes here. But I could probably move my stop to scratch at 50%. Basically, that's just a Wyckoff check, right? So this thing comes down, it checks the original bottom, and if that's for real, then you just get the hell out. That's an interesting development there through the end of the conference. US dollar just got its ass kicked through that, eh? So that's fascinating. I noticed over here, look at the Swiss franc just flying. So that should be bullish at gold. The interesting thing is gold and crude can't really move up in unison. So notice how gold and silver are taking off here, but the oil is just, it's floundering here. Coming out of this is an interesting development. I talked to you guys about this heading into this. So the wedge clearly is broken to the downside, and we saw that big sort of breakout there. So now I guess the question is, do we start doing some more technical damage through that level? So that's what we're playing with right now. Then the next one is here. So if we can get that, then we'll get one of those, the market is smiling at you. So this might be the wink. I'm not quite sure how to describe that, but like sort of like the eye within the eye. This is like a double, it's like a wink. That's the only way I know how to describe it. So keep your eyes open for that. If we do get this top in the spreads, it probably wants to come back down to here, sort of down into this area, and that'll set up a pretty big Bitcoin rally. Usually when this thing tanks, that's when Bitcoin comes off. So remember yesterday, the day before, we had that big dump in Bitcoin, which kind of set up a top. And you can see now, if we resolve through the upside here, then it means more dumpage. And I doubt that's going to happen because this thing doesn't really like to go much higher than there. I think it's the rubber band's already been stretched. So if anything, that says that, the fact that we probably have to play at this level too, and then probably also this level too, means probably like trading range. We're going to set up some sort of consolidation pattern here. That would be my guess. So if we're looking at the corn itself, yeah, so the sell-off is done, right? That wink in the market, you can see big old double bottoms come in here on the corn. Is this a rip-roaring new bull market? Probably not. Like Paul tonight, my hunch is, it'd be interesting to see what he says, but my hunch is he'd probably be interested in taking short shots up in this area here. So then that would correspond with that spread kind of thing. Probably to watch a level to watch for a trade would be against that high. Notice that's right into that 786 and it's right into the original top there. So that's probably the level to keep an eye on. Probably also too, we could do like fog and bombs. Boom, boom, and boom. Hey, there you go. 2.618 right up against that original top. And that kind of makes sense, right? Market rallies up into here. The guys that actually did short this, they're going to come in and short it again. They'll defend their trade. And then, of course, guys that bought up here and like, oh my God, yeah, I got to get off of the couch, right? They'll be liquidating their positions in here. So that would make sense. And interestingly enough, I think David, huh?
Yeah, head and shoulder pattern.
Hello. Okay. David in the YouTube audience there pointed out that it just looked to him like all we did was just go from one reload zone to another. And I actually thought that was a really good observation. So look how cliche this is. It's ridiculous how cliche this stuff is, right? And then on the upside, right? And so, on the site we have like, I don't know whether I can show you or not. We have this is what we would play. It's just cat ping pong, RLZ ping pong right now, back and forth, back and forth, back and forth. So that's what it looks like it's going on right now. And I do like that thinking, especially with regard to the spreads, because the spreads don't look like they're totally getting ready to puke out here. There's gonna be a couple fights in here. Oh, interesting to see. Look at the Swiss franc just going for it. So that's got to be bullish of gold. Look at the euro. Oh, the Japanese yen keeps going higher. Did I get blown out on my little trade here? Ooh, stock market's breaking higher. Jesus, that stock market looks strong. I don't know. It's just sitting at scratch, not really doing anything. Fascinating. Well, folks, if anything, if we were going to put a tag on this, Chris, or rares, I don't know if we'll put this on the site or not, but definitely in the description on the YouTube video. This was such a good example of why you never trust the first hour of trading following a Fed announcement, right? Because the Fed announcement was here. They washed the stops, anybody that was long, boom, washed them all out. Then exact opposite. Anybody who shorted the Fed announcement, thought they were going to make a ton of money, boom, let's wash them out. Then anybody's like, okay, that's it, the bottom's in, let's go long, boom, they go and wash them out. Then you get just a big washout going the other direction. Let's clean it. Because there was probably, you know what, I wouldn't even be surprised if there was guys that went, well, there's that, there's that, there's that, so I'm going short. All right, and boom, let's blast all them out up top here. And now the interesting thing about this is, what do you think the odds are that a bearish momentum divergence is forming here? I bet probably pretty good. The only problem is that's on a very lower time frame basis. So the higher time frame still looks super bullish. I think you would just got to leave this alone, let it settle down a bit. But yeah, so day trader row, there's the bear div in MACD. You can even see that it was a bear div on volume too. So clearly this was some massive stop hunt liquidation, and there was just so many orders the market just surged higher here. Look at all that volume. Ay, caramba. But as soon as that was done, then it was done. And there wasn't anything more in the tank. And now if this slips down below, the 13 EMA, this is why I like using the 13 EMA. If we slip down through here and that level on the Dow, or this is the ES, right? So you could even just put up a nice little pivot line there. And, I know guys that would do that and say, can I please have an M on the other side of this trend line? So that's what that would represent. If we break down through this low, then, next stop is 30 SMA, next stop's 200 SMA. And really you could probably even just, do fibs and stuff. So there to there. Yeah, what a surprise. Reload zone, like David was saying there earlier. All they're really doing is just playing reload zone ping pong. You could be hunting along here. Ideally, you'd like to see like 33% retracement. And with the way the momentum indicators look, I think that would be a bit dangerous. Probably let this stuff bottom, let W's start coming in. I don't like the fact that Willie's so stupid like this. This would be a ballsy trade. But ballsy trades are ballsy trades. So we haven't even done 33. So I don't even know if I could even use that range. I don't think I can. You know what? I think it's probably something like that where we go boom, 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 and work up into this ATR level. Keep in mind, this ATR script is so boss. Very rarely do you ever see the market really move substantially higher than an ATR, especially so late in the day here. So does it even make sense to put on a new short so late in the day here? Probably not. So I wouldn't even be surprised if you actually see some sort of rolling top come in through that Asian kill zone, because they often call that Asian session the institutional session. So it's now been just about an hour since the Fed announcement. I think we can start believing what we're seeing. I don't see an M top. You can notice right across the board, the M top will come in on a fail on this ES through that level there on the Dow, that low there, and that's 34,112. We're at 34,196, putting in potential railroad tracks here. So unless this thing pukes out and heads down through these lows, I don't think this thing's going to break down here. And yeah, look at that. So US dollar, actually, this would be interesting to watch. US dollar did sort of a dead cat bounce, then faded back down against the lows. For this thing to actually really rock and roll, you're going to need to see it recapture these levels. And with that kind of wick, that shooting star there and against these, man, I wouldn't put a lot of faith into that happening. So interesting, we talked about crypto as a leading indicator. So you can see Ethereum's already pressing the highs. Looks like my little yen ideas under water there. There goes Ethereum. Looks like Ethereum is about to break out through the highs. We should probably check out what the total market's doing. Wow, look at all these momentum bottoms. Jesus, this market's strong. Have I said that a few times? I think I feel like a broken record. Strong like bull. Oh, look at that. Yeah, so we're heading down. We've confirmed that. We're going down against these lows now. They're on our fun little spread trade. What I want to see is what the total market looks like. Yeah. So total market has put in a W. Boom, 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 boom. You could probably even start doing things like Foggenbaums. So this should be a fun show tonight. And actually, we do the show in about 6 hours or so. So let's see what we got here. Yeah. Total, I'd say total wants to take a serious run at those previous peaks up there. Fascinating. Wow, what an incredible market, eh? I tell you, in the entire time that I've worked in the stock market, of course, I didn't work in the stock market in the 1980s. Well, got my first job in '88, so that was at the very end of that decade. But the more I look at it, the more I see that this market sure looks like the early 1980s and the early 1940s. We did actually a really cool study last night on that idea. So, yeah, I'd say the market, look at that. Ethereum's just going for it here. Probably a lot of these altcoins. Eddie, how's your portfolio looking? It must be launching higher here. Yeah, look at, so isn't that interesting? A site member, the Matador, he gave us a list of a whole bunch of names he thought weekly W's were working off of. And man, these names have just outperformed. It's been quite remarkable. Lots of green. Look at this. I think we were looking at the artificial intelligence names. Look at that green right across the board. I remember this is one that we were looking at a while ago. Anyway, nice big up move there. This is Sjord's list on the DeFi and poor old Sjord. He must be so pissed off. You should come on the site if you're interested. He did a presentation on Tuesday, and for whatever it's worth, I still got my bid working down at the bottom. But this was Sjord's idea, a fantastic idea. Did pretty good fundamental research. Very plausible story. It's just not quitting. So remarkable to see. This is Zugi's. This is Zugi's gift to us. Huge move up. I was thinking that we needed to calm down here a little bit. We'll see how it goes here. I mean, there ain't no quit yet. V top, V bottom. We'll see what happens. But thank you for that gift, Zug. And there's even these names. I don't even like saying these kind of names publicly. That feels like such a potty mouth thing. But gee whiz, that thing looks like somebody just needs to give it the green light. Away it goes. Anyway, we got some of that on the books. This is one that's pissed me off that I wanted to get in, but it looks like I've just been left behind. I was in this, then walked away when it broke down through here, and I was kind of like, well, that was a smart move. Didn't even really get a half decent bottom in here, and I got a feeling this damn thing's gonna rocket up here. Anyway, so should be an interesting crypto market. Lots of green on the screen. And actually, if you're watching this and you've been, if you watch this later on, we're thinking about getting the Bitcoin and altcoin trading talk shows back up and running on with the Coinigy people. I had a good meeting this morning. So let us know in the feedback comments, all that kind of stuff, whether you remember the bad shows. Jesus, look at this, eh? Rock and roll. Rally, pitcher's named Sally. Did we look how quickly we hit that 2.618? That's ridiculous. That's not supposed to happen that quick. What the hell? It's that was in like 5 minutes. That's ridiculous. Oh goodness. Let's see what we got here. Yeah, look at that. Holy volatility, Batman. Up and down like a you know what. And actually, that was interesting off of clotheslines. If I actually take it to the candle bodies, then, wicks and tails, then wicks and tails say we could easily come up into these highs here. So, wow, what a market. And wicks and tails. Remember, actually, this is a really good analogy. I would keep a close eye on this level here. The clothesline of those levels, right? 23,680. I often say I love candle body highs for trade location. Look at that. We're coming into it like a boss here. Remarkable. That's remarkable how strong this price action is. Quite remarkable. Look at that gold just going for it. And interesting enough, you heard Powell saying, well, the goods prices are coming down. I think that specifically he was talking about crude oil and energy. So... all right, well, I think there's not a hell of a lot more I can add to the equation here. We will be doing a show this evening with Paul and Ben. So if you happen to be here in North America or in Asia and you want to talk a bit more crypto, and like I said, about 5 or 6 hours, I'll be back for that. But interesting looking market, very strong. I think the market liked what it heard out of the Fed. But, This is the one thing I will say. I'll just leave off on this. I'm a little concerned that are we walking into a trap? When the hell was that one? I think it was here. Let's see. Yeah. So last FOMC, they actually took them, or two FOMCs, they took the market a bit higher and then dumped it. Blah, jerks. Last FOMC took it up into the bit and then dumped it. Blah, jerks. We haven't broken out here. Remember we said, watch those candle body highs, watch this high. And this is the peak from January 25th. So watch that high there, candle body highs for trade location. Watch how the market acts in here. And of course, if we do roll over and M out, then put a fork in her. It hasn't M'd out just yet. We did start to get the smatterings of a top. You can really see this is a 3-bar fractal. So the fractal itself will fire if we go through that low. And that would, of course, if we don't break to new highs, that would create a big fat M. So no sales signal here just yet, but probably a little dangerous to be just, hey, let's go buy some Bitcoins. I'd be a bit leery about that. Anyway. All right, well, we'll leave it at that. Hope you guys enjoyed that fun FOMC event, and we'll see everybody tonight and talk a little bit about, there is a, somebody mentioned on YouTube, there is a 4.669 that's just slightly above us here. Yeah, right there. Yeah, that's still potentially on the table here. If we do pop up through the top, I think there'll be enough inertia to take us up into this level. And we're getting pretty darn close to this liquidity pool. So if they do take the market up through here, don't be shocked if they take a serious run at this high up here and go after those stops. But we'll talk lots about that tonight. So, all right, Chris, if you could take us on out of here, I'd appreciate it. All the best and bye for now.